So for the stock portion of your overall investments, you could have a collection of individual stocks, mutual funds, or exchange traded funds, or a combination of all these types of things. So we're going to look at each of them in turn. And most folks have a combination of these different types of vehicles, but you don't have to. You could have just stocks, just mutual funds, just ETFs. So let's take a look at that. So let's say you want to make a portfolio of just individual stocks, or what are the advantages of owning individual stocks versus, let's say, a mutual fund or ETF. So with individual stocks, you have more control. You get to decide when to sell and when to buy, of course, but when to sell stocks. So if you think about a mutual fund, you have maybe a fund manager, or maybe it's an index fund that's automatically buying and selling stocks to balance the index. The fund to the index, or if you have an active manager, like in a stock mutual fund where you have somebody actually making those decisions for you. You buy the mutual fund and they decide what they're going to buy, what they're going to sell, and when they're buying and when they're selling, and all of that. So you give up that control to get that diversification and that expertise. But they're making all the decisions, where if you buy an individual stock, you have all the control. You get to decide when you want to buy it, and you can decide when to sell it. Because of that, it makes individual stocks more tax efficient. Mutual funds are constantly buying and selling stocks. Some do more so than others. If you're looking at mutual fund, look at things about around turnover. A higher turnover number, like 100% turnover, means they're essentially turning over all their stock holdings each year on an annual basis. So high turnover numbers is causing lots of buying and selling, which causes possibly tax implications. Now, a good active fund manager will try to balance what they sell versus what they buy and try to mitigate those tax things. But either way, they're making the decisions and they're incurring possible tax implications for you by that buying and selling. Otherwise known as churning too, where they're kind of constantly doing that to try to, drive, some great returns. Hopefully is what you're looking for them to do. If you own individual stocks, it can be much more tax efficient because you don't pay taxes on the stock until you sell the stock. If you buy it at this price, a low price, and you sell it at a higher price, that difference is your gain, or your capital gain, and that's what you're paying taxes on. But that only occurs for the capital gain portion when you sell the stock. So if you buy a stock here and you don't sell it for many years, or maybe for a long time, decades even, well, you're not incurring any taxes from a selling or a capital gain type thing. So I own some stocks, for example, that I've held for decades and more than decades, and they've really gone up in value, which means when I sell them, I'm going to have a big tax consequence. But by holding them, they'll continue to go in value. I think they're good stocks. They pay dividends. And so they're much more tax efficient, and I'm not incurring that cost now. In fact, those are some stocks I might pass on to my son or my heirs that they can maybe, with some different tax vehicles, tax advantages, take advantage of that and have it become part of their own portfolio after I die. So I can put off that tax implication. Now, one thing about that, I'm talking about the gain, the price that you sell high and buy low, and that difference, that's your taxable gain in terms of tax efficiency. You can put that off. But many stocks pay dividends, or income type of stocks. They pay you a dividend, they pay you a quarterly dividend, and that's income coming into you. So that is basically potentially taxable income depending on where you live. In the United States, that would be taxable income. So either way, with individual stocks, because you have that control and how you can buy and sell when you want to, there can be much more tax efficient. Also, individual stocks are more targeted. You get to buy that individual stock. If you're buying a mutual fund, you're buying a basket of stocks. I've seen some mutual funds have as low as like 25, 30 stocks, and really, really concentrated, but you're still buying those 25 or 30 stocks. If you buy, let's say, like a Standard & Poor's 500 fund, well, you're buying 500 different types of stocks, or buying into that in different weighting or different percentage of those stocks, but you're buying all those stocks. But with buying individual stocks, you can buy that one particular company. Maybe there's a company that's really of interest to you, and you've done your research and maybe applied some of the things in this course as far as the fundamentals and the ratios and all the analysis that you're going to be learning. And then you're targeting more courses, targeting your stocks based on that, and that's a great thing. So you can be more targeted and build your own basket of stocks. Now, the downside, by buying individual stocks, you can be less diversified. I mean, you want to maybe get 15, 20, 30 types of stocks. Well, that's still a lot less stocks than, let's say, a portfolio that owns 500, or a mutual fund that owns 500 stocks, or maybe it's the entire stock market index that holds thousands of stocks. So you will have less diversification, which can be good if you want to be more concentrated in some areas, but could be bad as far as having less diversification. when you're buying individual stocks, the onus is on you now to do your research, your due diligence, and to see, by picking those stocks. So apply the things and be more actively involved in your investing versus, say, picking a mutual fund and just letting it be. Maybe a real passive investor. Active and passive are good things depending what you're looking to do. But let's say I want to buy just an index fund and I want to have just the 500 largest stocks, or I want to buy an index fund that tracks small cap stocks, or whatever I'm looking to do. I can buy that fund and kind of set it and forget it, and that mutual fund manager will make the decisions for me, or if it's an index fund, it'll track that index. It does it automatically. I don't have to do anything more. I just do my research, pick out the fund, and I'm done. Where with stocks, much more hands-on, I got to pick out the individual stocks from all these tens of thousands of stocks out there and pick the ones that I feel are the best for me and for my goals. And then once I pick those stocks, I got to track the results. I got to see how they're doing and what's happening in the industry and make changes as they go. Now, some stocks, especially like a dividend-paying stock, you might feel real comfortable buying and holding that forever, and it's going to pay you dividends along the way. But stocks go up and down, especially individual stocks are more volatile than a mutual fund of many stocks. So I have to track that much more closely. So if you have individual stocks in your portfolio, you want to really track that closely. And that's the same thing too. If you want to have an entire portfolio of just individual stocks, well, having 3 or 4 is so little diversification, it can be very, very risky to do that. Or putting all your eggs in one basket and buying one stock, or buying one company stock, maybe the employer you work for, that's really, really risky to do. So, most experts are saying 15 to 20. I think it's good 20 to 30. As far as all you have is individual stocks, you want to have that breadth across different industry sectors, different size of market cap, different types of organizations, large, medium, and small market cap, and maybe even have a variety of growth and income stocks too, depending, once again, on what your goals are. But if you have 10 or less, you're not getting the diversification you could really benefit from at least having 15, 20, or 30. And so to be more diversified, look at different industries, different sizes of organizations within those industries, and the style too. Is it growth? Is it income? To build your overall portfolio. Now, a strategy I like around individual stocks is actually to kind of pair it with mutual funds, and in a setup where you have like a core of mutual funds, and maybe some few core mutual funds that are your core things, and then you have individual stocks kind of circulating around that core, so to speak, to round out your overall portfolio. So you have both a mixture of mutual funds and individual stocks. As we'll learn in the mutual fund area, there's advantages and disadvantages of mutual funds, so we'll look at that as well. But a good strategy to get you more diversification, get you a broader breadth of things, particularly in areas that you might not know as well or want to research more, or let somebody actually be more of the expert in that area, is maybe to get mutual funds in that area. A good core too might be some safer index mutual funds that are very low cost, so you're not paying a lot in fees, and to hold those, that can be your core, and then you build around that individual stocks. So one way you could do is, let's say 80% of your portfolio, of your stock portion of your overall portfolio, that might have bonds and cash, but of your stock portion, maybe 80% of that's in mutual funds or an exchange traded fund, or something that's really maybe more low risk, and gives you that diversification by being invested in a lot of different areas. Maybe a total stock market index fund, or an S&P fund, or an international type fund, or maybe you have those core ones and then you add a couple other funds that might be more actively managed, maybe in a sector like energy or healthcare, where you want a more active manager, for example. Or you could go with an index in those areas too. There's different advantages of all those things, that we're going to learn about that within the mutual fund section. But the core is mutual funds, and then you add individual stocks around that core. So you don't have to worry about trying to track or buy 20 to 30 stocks and being on top of it and being pretty risky investment in just those small holdings. You can have that big core, and then around it, then buy individual stocks on things that you can maybe get a little bit of an extra return out of, because you might know those stocks are done really good research on a few stocks versus trying to build a whole portfolio of individual stocks. And that way you can really vary your holdings. It's a real advantage for individuals. You can have varied holdings. You maybe want to buy a couple healthcare stocks or whatever, something. Maybe it's something you have experience in a particular industry in, maybe an industry you work in or have worked in, or you just have a real strong interest in it. You can buy some individual stocks there and take advantage of some of those tax advantages where you don't have the distributions or tax consequences for mutual funds. You can really maybe buy and hold individual stocks for some time. And it can be challenging and fun. I mean, partake in this course is to learn to trade and buy stocks, whether it's a mutual fund or ETF. But part of this might be you want to do some with individual stocks. You'll have some knowledge to do that from the course, so put those things into play. And it can be challenging, it can be fun, but it's a little bit less challenging and maybe a lot less risky to have that core mutual funds and then maybe building up your individual stocks as you get more experience and as you try some new things. But you can always have that core of mutual funds. Remember, boring sometimes wins the race, right? You're not trading, you're not gambling. It's just kind of that investing. It can be a little boring, I guess, but I find it interesting. But it can be even more interesting if you're buying individual stocks. So that's one strategy you can do, one that I use, and it works very well. To have the core and then buy individual stocks around it. But you can buy just all mutual funds or just exchange traded funds as well. And we're going to talk about those next.